To analyze his career is to move beyond the study of trading tactics and into the realm of grand strategy. Morgan's operational theater was not the ticker tape, but the corporate boardroom and the national balance sheet. His objective was not to outguess the market's ephemeral moods, but to impose a lasting, rational order upon the very industries that constituted the American economy. His life's work was a testament to a single, overarching philosophy: that fierce, unregulated competition was a destructive, wasteful force, and that stability, efficiency, and predictable returns could only be achieved through consolidation and centralized control under sound management. This is not the examination of a stock operator's methods. It is the analysis of the operational doctrine of the man who organized modern American capitalism. We will dissect the three core pillars of his methodology: the strategy of industrial consolidation, the use of capital as a tool of power and control, and his role as the reluctant but absolute central banker of his era. The first and most famous pillar of the Morgan doctrine was the strategy he pioneered, a process that would become so synonymous with his name that it was given its own verb: Morganization. This was his answer to the central economic problem of the Gilded Age. The late 19th century was an era of explosive, unregulated industrial growth that fostered a state of perpetual anarchic warfare in key industries. The most critical of these was the railroad network, the circulatory system of the American economy. This industry was plagued by overbuilding redundant and parallel lines and, consequently, brutal and unsustainable price wars. Competing railroad barons, in a desperate bid to secure traffic and service their massive debts, would slash freight rates to levels far below their own costs. This was not the healthy, productive competition of economic textbooks. It was a nihilistic race to the bottom that drove even the largest railroad systems into receivership, destabilizing the entire financial system and triggering widespread economic panics. Morgan, as a preeminent financier whose firm had deep interests in railroad bonds, viewed this chaos with profound disdain. His worldview was shaped by his devout Episcopalian faith, which instilled in him a powerful belief in hierarchy, structure, and moral order. He saw destructive competition as not just inefficient and unprofitable, but as a form of societal sin, a chaotic waste of capital, resources, and human effort. His solution was Morganization, the forceful consolidation of these warring competitors into a single, rationalized entity under his direct financial control and strategic guidance. The mechanism he developed was a masterclass in financial power and psychological pressure. The process typically began when an industry had competed itself to the brink of collapse. Morgan would summon the heads of the warring factions to his formidable library at 219 Madison Avenue. This was not an invitation to a negotiation among equals. It was a summons to appear before the ultimate arbiter of American capital. Inside the library, surrounded by priceless manuscripts and Renaissance art, Morgan would present his plan for consolidation. He would outline the structure of a new unified corporation, dictating the terms of the exchange of old securities for new ones. He would then, famously, leverage the environment he had created. In some of his most legendary confrontations, he would lock the doors, forcing these powerful, egotistical men to remain in the room, sometimes all night, until they came to an agreement on his terms. The psychological weight of being in his imposing presence, combined with the grim financial reality they faced outside his walls, almost always led to capitulation. A successful Morganization resulted in the creation of a massive new trust or corporation. The old competing stocks and bonds would be exchanged for the securities of the new entity, a complex process for which the House of Morgan would charge a substantial commission. But the most critical component, the true source of his enduring power, was the installation of Morgan-selected directors onto the new company's board. This was the mechanism of control. The Morgan man on the board was there to ensure the company was run the Morgan way, with fiscal conservatism, operational efficiency, and, most importantly, in cooperation with other Morgan-controlled companies to maintain price stability in what he termed a community of interest. This network of interlocking directorates was his ultimate vision, a planned cartel-like economy run by and for the benefit of its most powerful financiers, with the goal of creating stability and predictable returns for investors. The crowning achievement of this strategy, the single act that cemented his status as the most powerful private citizen in the world, was the creation of the United States Steel Corporation in 1901. For years, the steel industry had been a hotbed of the very competition Morgan detested. The dominant figure, Andrew Carnegie, had built a hyper-efficient, vertically integrated empire and was known for ruthlessly crushing his competitors through relentless price cuts. In late 1900, Carnegie, feeling the pressure from new industrial combinations being formed by Morgan, threatened to unleash a final catastrophic price war by building a massive new tube plant that would have decimated the profitability of the entire sector. Morgan recognized this as an existential threat not only to his own steel interests, but to the stability of the national industrial economy. He decided that the only solution was to buy Carnegie out and consolidate the entire industry under his control. The negotiation was a microcosm of Morgan's methods. He worked through an intermediary, his trusted associate Charles Schwab, who was also the president of Carnegie Steel. After a now famous all-night meeting with Carnegie, Schwab returned to Morgan with a number scribbled on a piece of paper. Approximately $480 million for Carnegie's entire steel empire. It was an astronomical sum, equivalent to tens of billions in modern currency. Morgan's response was immediate and decisive. I accept this price. There was no haggling. He saw the strategic necessity and acted. Over the next few weeks, Morgan and his partners worked feverishly, negotiating with the heads of Federal Steel, National Tube, and a half-dozen other major steel producers, convincing them to merge their operations into one colossal entity. The result was U.S. Steel, the world's first billion-dollar corporation, capitalized at $1.4 billion, a figure larger than the entire United States federal budget at the time. It was a breathtaking act of financial engineering that ended the price wars, stabilized the industry, and concentrated an unprecedented amount of industrial power under the financial umbrella of the House of Morgan. It was the ultimate expression of his belief that order, imposed from the top down by a powerful and rational financier, was superior to the chaotic and destructive forces of an unregulated market. The second pillar of Morgan's doctrine was his strategic use of capital as an instrument of power and industrial organization. In an era with little regulation, no official credit ratings, and no deep public sources of financial information, the most valuable asset a banker could possess was an unimpeachable reputation. The name J.P. Morgan and Company became the ultimate seal of approval. Morgan understood that his firm's credibility, built over decades, was the key that unlocked the vast capital reserves of wealthy families in New York and, more importantly, the even deeper pockets of investors in London and Paris. This reputation allowed him to act as the primary gatekeeper for the financing of American industrialization. A project backed by the House of Morgan was considered sound, trustworthy, and destined for success, attracting capital that would be unavailable to others. He did not simply find money for clients. He decided which industries would be built and which entrepreneurs would be anointed as leaders. Morgan's strategy for deploying this capital was based on two principles: character and control. When asked at a congressional hearing what the primary basis for commercial credit was, he famously replied, "The first thing is character, before money or property or anything else." He refused to back individuals he considered reckless, dishonest, or purely speculative. He sought out men who were masters of their industry, men of substance and integrity who shared his vision of building stable, long-term enterprises. He was not interested in financing short-term stock market operations. He was interested in financing the creation of enduring industrial assets. This preference for character was not altruism. It was sound business. He knew that the success of a long-term venture depended entirely on the quality of the people running it. Once he had decided to back an entrepreneur or a project, he insisted on the second principle: control. A Morgan financing deal was never a passive investment. It invariably came with the condition that one or more Morgan partners would be placed on the company's board of directors. This Morgan man on the board was there to ensure the company was managed according to his principles: fiscal conservatism, operational efficiency, and a commitment to maintaining stable prices within its industry. This gave him a direct hand in the strategic direction of a vast swath of the American economy, from railroads to manufacturing to utilities. Perhaps the most dramatic illustration of his power over not just companies but the nation itself was his intervention during the 1895 gold crisis. In the mid-1890s, due to the effects of the Sherman Silver Purchase Act and a general economic depression, the United States Treasury was rapidly losing its gold reserves. The government was legally obligated to redeem paper currency for gold, and foreign investors, fearing a devaluation of the dollar, were cashing in their notes en masse. The nation was on the verge of defaulting on its obligations, a catastrophic event that would have shattered its creditworthiness and triggered a global financial panic. The Cleveland administration attempted several public bond offerings to replenish the gold, but they failed, as public confidence had evaporated. With the Treasury's reserves dwindling to a dangerously low level, the government was forced to turn to its most powerful and politically controversial private citizen, J.P. Morgan. Morgan, along with the banker August Belmont, formed a private syndicate to provide the U.S. Treasury with 3.5 million ounces of gold, a significant portion of which they had to source from their European banking connections. In exchange, the syndicate received government bonds at a favorable price, which they then resold to the public at a profit. The deal was politically explosive, with critics accusing Morgan of extorting the government and profiting from the nation's distress. But it was undeniably effective. The infusion of gold stabilized the Treasury, restored confidence in the dollar, and averted the immediate crisis. The episode was a stark demonstration of Morgan's doctrine in action. He saw a system in chaos, diagnosed the problem, and used his unique access to global capital and his unimpeachable credibility to impose a solution. He acted where the government was powerless, proving that at that moment in history, the private power of the House of Morgan was more critical to the nation's financial stability than the public power of the U.S. Treasury. The most transformative example of John Pierpont Morgan's strategy of using capital as a tool for industrial organization was his role in financing Thomas Edison and creating the modern General Electric. The story is a perfect case study in his methodology of imposing order on chaotic genius. Edison was an undisputed inventive visionary, but his business affairs were a disorganized tangle of competing companies, constant cash shortages, and distracting patent disputes. Morgan's father, Junius, had been an early backer of Edison's work, but it was J.P. Morgan who saw both the world-changing potential of electric light and the urgent need for financial and organizational discipline to realize it. In the 1880s, the burgeoning electrical industry was embroiled in a costly and inefficient conflict known as the War of the Currents. Edison championed direct current, or DC, while his formidable rival George Westinghouse backed the alternating current system, or AC, developed by Nikola Tesla. This was not merely a technical debate. It was a battle for the fundamental infrastructure of a new age, and the competing standards were hindering mass adoption and creating massive investor uncertainty. Morgan, who had consolidated Edison's various ventures into Edison General Electric in 1889, viewed this war as another form of the destructive competition he abhorred. His goal was not to pick the winning technology based on its scientific merits, but to create a dominant, stable, and profitable corporate entity that could end the war and monopolize the future. His solution was a masterstroke of financial pragmatism. He engineered the merger of Edison General Electric with its primary rival, the Thomson-Houston Electric Company, a firm that controlled key AC patents. The new entity, formed in 1892, was called simply General Electric. In a telling move, Morgan insisted on dropping Edison's name from the new corporation. This was a clear signal of a new era. The age of the inventor was over, and the age of the financier had begun. The company would no longer be driven by the volatile genius of one man, but by the disciplined professional management installed and overseen by the House of Morgan. Morgan and his partners controlled the board, providing the financial discipline and strategic vision the company needed to rationalize its operations, fund its massive expansion, and establish its unquestioned dominance in the electrical industry. Morgan's strategy was not merely to finance an invention. It was to create a stable, powerful industrial giant that had the scale, financial strength, and organizational structure to electrify a nation. He organized the future. The third pillar of Morgan's operational doctrine was his most dramatic and historically significant, his role as the reluctant but undisputed central banker of the United States. In the decades before the creation of the Federal Reserve in 1913, the American banking system was inherently fragile. It was a decentralized network of thousands of independent national banks and state-chartered trust companies, with no central institution to provide liquidity or coordinate a response during a crisis. The nation's currency supply was inelastic, meaning it could not expand to meet the increased demand for cash during a harvest season, or, more dangerously, during a financial panic. This structural weakness meant that a single high-profile failure could trigger a contagion of fear, leading to bank runs, a hoarding of cash, a freezing of credit, and a full-blown financial collapse. Morgan, as the nation's preeminent banker whose own fortune and industrial empire were built upon this fragile system, understood this risk better than anyone. On multiple occasions, he was forced to step into the void and use his immense private power to halt a national crisis, acting not out of altruism, but out of a sense of enlightened self-interest and a profound, almost patrician, belief in his own duty to maintain order. The ultimate test of this role, the moment that forever defined his legacy, came during the devastating panic of 1907. The environment leading up to the crisis was one of rampant prosperity and unchecked speculation. The American economy was booming, but much of the growth was financed by a rapidly expanding and loosely regulated sector of financial institutions known as trust companies. These trusts competed directly with traditional banks but operated with lower reserve requirements, allowing them to take on greater risks in pursuit of higher returns, particularly in the volatile coal money market that financed stock market speculation. The financial system was awash in credit, but its foundations were brittle. The spark that ignited this tinderbox came in October 1907 with a failed attempt by a group of speculators, led by F. Augustus Heinze and Charles W. Morse, to corner the stock of the United Copper Company. When the corner failed spectacularly, the stock's price collapsed, bankrupting the speculators and, more critically, the banks and trusts they were associated with. The contagion began immediately. On Monday, October 21st, news of the failed corner spread, and depositors began to pull money from the institutions linked to Heinze. The panic escalated dramatically on Tuesday, October 22nd, when a massive run began on the Knickerbocker Trust Company. New York's third-largest trust, whose president, Charles T. Barney, had loose ties to the speculators. Despite being solvent, the trust could not withstand the relentless withdrawals, and by the end of the day it was forced to suspend operations. The failure of such a major institution sent a wave of terror through the city. Credit froze solid. The very next day, the panic metastasized, spreading to another major institution, the Trust Company of America. Into this vortex of fear and collapse stepped the 70-year-old J.P. Morgan. Returning to his office from a trip, he immediately took command. The federal government was largely powerless. President Theodore Roosevelt, a fierce critic of Morgan and the malefactors of great wealth, had no mechanism to effectively intervene. Morgan became the de facto commander-in-chief of Wall Street, and his library at Madison Avenue and 36th Street became the nation's financial command center. His first move was one of triage. He summoned committees of the brightest young bankers from New York's top firms, dispatching them to the offices of the beleaguered trust companies. Their mission was to conduct emergency, all-night audits to separate the institutions that were fundamentally solvent but illiquid from those that were truly bankrupt. The fate of the entire system hinged on saving the Trust Company of America. After a grueling overnight examination of its books, the audit committee reported to Morgan that the trust was sound. Morgan knew it had to be saved. The climax of the crisis took place in his library. He convened the presidents of all the major trust companies, men who were his rivals and who were hesitant to risk their own capital to save a competitor. He laid out the stark reality. If the Trust Company of America failed, the public would lose faith in all trusts, and they would all be destroyed in a wave of bank runs. He demanded that they pool their resources to create a rescue fund. When they hesitated and began to argue, he locked the doors of the library, informing them that no one would leave until they had signed a pledge to commit the necessary capital. His sheer force of will, his unquestioned authority, and the gravity of the situation compelled them to agree in the early hours of the morning. But Morgan was fighting a war on multiple fronts. The New York Stock Exchange itself was on the verge of ceasing operations as the call money market had dried up, leaving brokers unable to obtain the loans they needed to settle their trades. A closure of the exchange would have been a catastrophic signal of complete financial collapse. Again, Morgan acted. He summoned the presidents of the major commercial banks, extracting pledges from them for a multi-million-dollar liquidity fund. He then personally directed the distribution of these funds to the most desperate brokers on the floor of the exchange, saving it from closure with just minutes to spare. Simultaneously, he had to orchestrate a bailout for the city of New York itself, which was on the verge of defaulting on its bonds. And in a final, masterful move, he neutralized another potential failure by arranging for his own U.S. Steel to acquire the Tennessee Coal, Iron, and Railroad Company, whose stock was held as collateral by a major brokerage firm that was about to go under. This move required him to get an emergency antitrust waiver from President Roosevelt, a testament to the severity of the crisis. The psychology of this type of market panic, where rational thought evaporates and is replaced by a primal stampede of fear, is not just a matter of historical record. It is documented firsthand from the perspective of a master speculator in a classic work of financial literature, Edwin Lefebvre's Reminiscences of a Stock Operator. In a remarkable passage in Chapter 8, the book's protagonist, Larry Livingston, the prototype of Jesse Livermore, describes being massively short the market during this exact 1907 panic, profiting immensely from the collapse. However, the narrative pivots when news arrives that J.P. Morgan himself has personally intervened to stabilize the system. The speculator recounts his decision to begin covering his shorts, not based on any technical signal from the tape, but as a direct acknowledgement of a superior force. It was a pragmatic admission that one does not bet against a man who could command the entire financial apparatus of the United States. This specific episode illustrates the sheer scale of Morgan's power. His intervention was so profound that it became a fundamental market factor in itself, capable of overriding the purely speculative trends that other operators had mastered. To truly understand the chaotic world that Morgan sought to control and the mindset of the individuals who inhabited it, this book is essential reading. To help absorb its timeless lessons on the mechanics of booms and busts, we have linked in the description a unique chapter-by-chapter analysis by Max Davidson, specifically designed for the modern reader. Through his personal intervention, J.P. Morgan single-handedly halted a panic that could have plunged the United States into a deep depression, demonstrating a power that no private citizen has wielded before or since. In reviewing the career of John Pierpont Morgan, one is confronted with a legacy of profound complexity. He was neither the selfless savior portrayed by his admirers nor the rapacious robber baron depicted by his critics. He was a force of nature, a man whose personal philosophy of order, stability, and control was so powerfully implemented that it fundamentally restructured the American economy. His strategies were all facets of a single overarching goal: the imposition of a rational, centralized, and efficient structure onto the chaotic, fragmented, and destructive capitalism of his era. The results of this campaign were monumental. The industrial consolidations he engineered, most notably U.S. Steel and General Electric, created corporations of unprecedented scale and efficiency. These entities laid the groundwork for America's rise to global economic supremacy in the 20th century, dominating industries, fostering research, and providing stable employment for hundreds of thousands. His dramatic personal intervention in the Panic of 1907 was the final undeniable proof that the nation could no longer afford to have its financial stability depend on the health and whims of one private citizen. This realization was the direct impetus for the creation of the Federal Reserve System in 1913, a public institution designed to perform the systemic functions that Morgan had been forced to carry out privately. However, this legacy of order came at a significant cost. The Morganization process, while ending destructive price wars, simultaneously created massive monopolies and trusts that dominated their respective industries. These entities often used their immense power to stifle smaller competitors, control prices, and exert enormous influence over political and regulatory affairs. This concentration of economic power in the hands of a few New York-based financiers was seen by many as fundamentally undemocratic and a threat to the American ideal of free enterprise. This backlash fueled the Progressive Era's antitrust movement and culminated in the Pujo Committee investigation of 1912, a congressional inquiry into the money trust. The committee, led by the fierce prosecutor Samuel Untermeyer, sought to expose the immense and hidden power that Morgan and his network of allied bankers held over American industry. The hearings were a dramatic showdown between the old world of unfettered financial power and the new world of government regulation. Morgan, old and in declining health, was called to testify. He was defiant, insisting that his actions had always been in the best interest of the country's economic stability. The most famous exchange of the hearings came when Untermeyer pressed him on the nature of financial power. Morgan's response encapsulated his entire worldview. He argued that the ultimate basis for credit was not collateral or money, but character. "A man I do not trust could not get money from me on all the bonds in Christendom," he stated. While this reflected his personal code of honor, it also revealed to his critics the terrifying reality of the system he had built. The economic fate of the nation rested on the subjective, personal judgments of one man and his small circle of partners. The Pujo Committee's final report concluded that a dangerous concentration of financial power did indeed exist, and it recommended a series of reforms that would lay the groundwork for decades of American financial regulation. Morgan died in 1913, just a few months after his testimony and before the creation of the Federal Reserve that would make his role as a private central banker obsolete. Years later, the Glass-Steagall Act of 1933 would fully dismantle his empire, forcing the separation of commercial banking, which became J.P. Morgan and Company, from investment banking, which spun off to become Morgan Stanley. The unified House of Morgan was no more. His career, therefore, forces us to confront a fundamental and enduring question about capitalism. Is the ultimate goal dynamic, chaotic competition with its cycles of boom and bust, or is it stable, controlled efficiency with its concentration of power? J.P. Morgan was the last and greatest of the private financiers who could bend the entire national economy to his will. He did not simply play the game of finance. He fundamentally designed the board, chose the players, and wrote the rules.